Hello, everyone. We have a very exciting topic to cover in Chapter 18, Financial Management. Now, in this course, we've talked about different type of business structures. We talked about different type of products, how to offer products, etc. But it's extremely important for a business that you understand financial management. And this chapter is going to cover the role of finance and financial managers, financial planning, the need for operating funds, obtaining both short term and long term financing. So, you ready? Let's go. First, let's talk about what is finance. It is the function in a business that acquires funds for the firm and manage those funds within the firm. So, as we know, every company needs funds in order to operate their business. What finance does, again, it is the acquisition of these funds as well as the management of these funds. So within financing, you're going to have to prepare budgets, do what we call cash flow analysis, and do planning for expenditures. And we'll discuss all of these concepts in greater detail. All right. Financial management is the job of managing a firm's resources to meet its goals and objectives. To do that, we hire what's known as financial manager. They're going to oversee the finances of that business organization. Their role consists of to examine the financial data and recommend strategies for improving financial performance. So as a finance manager, you are watching the inflows and outflow of the firm's funds, but you're also recommending strategies and how we can improve our overall performance. So part of your role consists of how do we obtain funds? What are our funding sources? We'll discuss those. And we'll talk about how do we control the use of funds effectively. Are we spending money unwisely? Are you spending money unwisely? Yes, I'm talking to you. All right. So we'll talk about controls put in place in order to control the use of funds. Michael Miller overhauled the underperforming Goodwill Industries. So as you all know, Goodwill is a non-for-profit organization. However, he decided to treat it like it was a for-profit business. He trimmed operating expenses. He compared sales by store. He had to close some of the weaker outlets and open new ones in better locations and cut distribution costs. By doing this, sales soared from 4 million, look at this, to over 135 million, eliminating the need for outside funding. So again, that is the role of a financial manager is to improve that firm's effective use of finance. So who are the who's who when it comes to finance? First, you have the CFO, known as the Chief Financial Officer. This person typically is going to oversee the entire finance department. You may have a CFP, Certified Financial Planner. This person is more for individuals. A CFP will help you oversee your finance and make sound financial decisions. A CFA is a chartered financial analyst. Typically, is going to work for a business organization, analyze the data of their firm. And then you have the comptroller, which is the chief accounting officer. These are some of the top positions in the field of finance. Now, this slide shows signs that show that you need a chief financial officer. Number one, you do not have information on key items like cash flows, working capitals, or forecast. This means, yes, you need a CFO. Number two, no one is carefully watching and analyzing your expenses. Yes, company, that means that you need a CFO. Next on the list, you are not aware of regulatory changes that could affect your business. You have to know what are the regulations from a governmental perspective that's going to impact your business. Number four is a killer. You are unable to generate financial reports. Mm-mm-mm. Yes, that means you need a CFO. And number five, drum roll please. Shareholders are frustrated with the lack of a CFO. So, yes, you need to have someone who understands finance overseeing the finance of a business organization. So, what does a financial manager do? I'm glad you asked that question. These are some of the responsibilities that you will have as being a financial manager. We'll cover some of this chapter, others later on. So, planning. Planning shows the projected inflows and outflows of business. Auditing. This could be more of an internal audit where we have policy procedures put in place to safeguard the assets of that business. Managing taxes. We'll talk about debt financing versus equity financing. Which approach is the most applicable for your business organization? So I'm going to go through all of these, but obtaining funds, that's your role. Controlling funds once they've come in, as well as collecting funds. Credit management, making sure that we have a good system in place so that we can keep track of who owes us money and collect those actual money. Now, as a financial manager, and that's my background, again, it's accounting and finance, we're saying what are some of your worries? Well, first of all, market unpredictability. So, right now, interest rates are going through the roof. Yes, for a mortgage, for a car note, just for borrowing money in period. Those interest rates are constantly increasing, or they're increasing in the current market. So that can cause a worry for a financial manager. Cyber threats, the threat of someone getting access to your company's financial information. Unfortunately, cyber attacks happen all the time. So we want to make sure that we have measures in place to try and safeguard our security, our financial information, our financial system from someone trying to steal our information. Other things are regulations from the government. The government can put regulations on that can impact the company's finances. The volatility of the dollar. The dollar sometimes up, sometimes is down. And the value of the dollar can impact a company's finances here in the good old US of A. Foreign competition. Is there other companies doing the same thing that we do? Because now competition is not domestic, it's global. All right. And then regulations for your specific environment that can have an impact on the finances of your company. These are some of the words you may have as being a financial manager. Now, it is extremely important that we understand finance. What I've said before, which is true, you will find that most of your CEOs and of course your CFOs are going to have an accounting and or a finance background. These are the most common reasons a firm fails financially. You ready? Number one, undercapitalization. What does that mean? It means that we do not have enough capital, which means funding, to operate our business organization, meaning that someone did not properly secure financing and or did not understand the amount of capital required to run our operational needs. Poor control over cash flow, meaning that no one is managing the cash inflows or cash outflows, or if it is being managed, they're not doing a good job of that. So we need to have someone that's overseeing the money coming in and the money going out. Inadequate expense control. We're just spending, people, out of control. No one is overseeing the company's expenses. These are the top 3 reasons why a company fails financially. They don't have enough funds, undercapitalized, poor control over their cash flow, and they have inadequate expense controls, mean that their spending is going to be more than what it should be. So as a financial manager, you're responsible for paying the company's bills and collecting overdue payments. So you make sure bills are being paid on time, and also that our clients are paying us on time as well. The finance functions are particularly critical to a small or medium-sized business because our fund is already limited. So it's extremely important that we make sure we account for every dollar coming in, every dollar going out. It's also essential that these managers stay abreast of opportunities or changes in finance, such as changes in tax law. So again, my background is as a tax accounting, and the tax laws change every year. So we're saying, how can we use those tax laws to our advantage? Well, that you won't know if you don't study the tax laws. All right. So here we have a company, and this company you see, they need finance to do things such as buy fuel and pay their employees. So they got these big machines out here, trucks that run on fuel. And the question is, what would happen to this company providing this work in the photo if it couldn't buy fuel for its trucks? And the answer is that they can't make money if they can't use their trucks, these trucks, for their intended purpose. Okay? Next, we'll talk about financial planning. What is financial planning? And although this is for a company, this is also applicable for you when it comes to your personal finance. It consists of analyzing your short term and your long term money flows to and from the company. So we're talking about money coming in, money coming out. We've identified 3 key steps to financial planning. First, forecast the firm's short term and long term financial needs. Now we're saying short term, how much money do we need for operating purposes, say for the next year? Long term may be for a time period of longer than 1 year, 3 years, 5 years, and or 10 years. Develop budgets to meet those needs. We're going to budget the cash, the expected cash inflows and cash outflows to see if we're going to have a surplus of funds or if we're going to have a deficit. Then let's put controls in place to see if the company is achieving its goals. So maybe on every month, let's see, did we meet our goals that we set for our short-term planning? Okay? So we'll talk about the components of a financial plan. As I mentioned before, there's both short-term and long-term forecasting, predict your needs on a short-term and long-term basis. You prepare what's called an operating budget or a master budget, which consists of a series of different budgets. There's a capital budget and a cash budget. And we'll talk about what is a capital budget and what is a cash budget. And let's make sure that we have some type of controls put in place in order to make sure that we are safeguarding the company's finances. Okay? So with the financial planning, forecasting is going to be important. We are now predicting the revenues, costs, and expenses for a period of 1 year or less. That's going to be short-term forecasting. For a period longer than 1 year, that's going to be long-term forecasting. Okay? So stay tuned for more exciting information on how a company deals with financial management.